Hello, everyone. Welcome to today's live session. So if you're new to these, just as a reminder, or if you're new, it's not a reminder, but we run them every day, whenever possible, at 12:30 for about 25 minutes. Let me just put the risk warning up. And it's a quick look at the major markets. So we take a look at the euro, the pound against the US dollar. We also take a look at the stock market indices, US markets and European markets, and also gold and oil, both of which are probably the most interesting in the last 24 hours because they're starting to break out again. But we'll take a look at all those markets. If you have any questions while I'm going through this, I can see someone's put a question in already about Apple. But any questions, just use the chat box on YouTube, and once we've been through the markets, I'll read the questions out. Just one thing, actually, while I'm on, we're just sorting this out now. But if you're based in the UK, and if you're in maybe the southeast or London in the UK, we're going to run an event on Saturday, March the 30th. So in about 6 weeks' time. It's open to clients and non-clients. It's going to be free, and we're going to do it down in Heathrow. We're going to do a hotel in Heathrow, and it'll run from about 11 till 4. But we're going to do a day on trading strategies. So that'll be run by me. We're just finalizing the details now. But if you'd be interested in attending, if you want to drop me an email, whether you're a client or not a client, I'll make sure you're on the list. So it's Saturday, March 30th, free of charge, coffee and a couple of sandwiches. And we'll be running it down in Heathrow. So it's drop me an email, david.jones at Capital.com. I'll make sure you get on the list. Right, let's get into it. Let's take a look at what is moving so far today. Just let's make this full screen. Okay, let's what should we start off with? Let's start off with the euro, actually, because I think the euro, there at the moment for euro US dollar, there are arguments for being a buyer and there are arguments for being a seller. Yet again, the recovery that we've seen since Friday, was it Friday? Yeah, Friday on euro US dollar from these lows at 112.40, it's run out of steam again. And this has been the problem for the euro. If we go back to the daily chart, this has been the problem for the euro since November of last year. It just cannot build on to any sort of recovery. I think what's knocked it back today was a comment from, I think it's the European Central Bank Vice President. He's been quoted in the French newspaper Le Monde, just saying how much a Brexit is going to knock the European economy, the continental European economy. So that's knocked back some of that euro recovery. But I think it's interesting here. We were looking at this yesterday. And I was saying that the big level is around about 112. It's the lows from November. That was the lowest the euro had been since June 2017. We were back pretty much down to these sort of levels again last week. So if it's going to bounce from anywhere, then that's the area. Okay, so there's a couple of ways of looking at this at the moment. Let me flick this over to an hourly chart. You know, if you think that the euro is going to rally from here, if I take a look at the lows from the week so far, so the lows from sort of yesterday, let's just flip this over to maybe a 5-minute chart. So the market has broken below the lows from yesterday. Yesterday's lows were around about 112.90, and actually the lows in Asia Sunday night 112.88. So the market's dropped as low as 112.75. So an aggressive trade. If you thought the market had euro US dollar had overreacted in the last sort of couple of hours or so, is to be a buyer with a stop loss under yesterday, under the low so far to today at 112.75. But if you thought, well, actually, the euro yet again cannot hold on to any recoveries, and we're going to go back towards yesterday's low and maybe that low from November 2018, you know, there's an argument for being a seller here with a stop loss above the high for today, around about 113.25. So these stops are relatively close because the euro there's just no volatility at the moment in euro US dollar. So I think it's interesting, but maybe a bit frustrating if you're trading it, because it doesn't actually go anywhere. So I think for now it's under a bit of pressure. The level to watch, the big level to watch, is that level from November last year. I would still say that if we apply normal chart analysis to this, that was the low from November. While that holds, we have to expect the euro to try and squeeze a bit higher, but it just can't manage it. But for now, that's the level. The RSI down here is also tying up with that. It's been oversold about a week ago. It's come out of oversold as the euro has rallied. So again, it's suggesting that maybe we should see some sort of base down here. The MACD, so the lower one you can see on the screen here, that hasn't quite given a buy signal yet. But if we see the euro actually recover a little bit from here, you'd expect in the next couple of days that will cross over and give a buy. So we're seeing a lack of volatility really, but it is, I think, bounce or bust time for euro US dollar down here. If it breaks 112, we've got to go back to the bigger picture. Here we go. So there's our big picture, our daily chart for euro US dollar, and we've got to start getting, I think, much more bearish. Maybe looking for a move back to 110, which would be May 2017 low. So it is, for me, is all about this 112 level for euro US dollar now. So even though I have to say it is pretty boring day to day, that's the level we should be watching. And so hopefully we'll either have the start of a proper recovery from here, which it's failed to manage in the last 3 months, or the level breaks and we can start looking at more aggressive downside targets. But it's just sort of flip-flopping around from 1 week to the next, euro dollar at the moment. But again, in the last 24 hours, it's failed to hold on to recovery. Let's have a look at the pound. The pound again is these are weird markets at the moment because of what is going on or not with Brexit politically in the UK. But we had unemployment numbers out today. Unemployment in the UK dropped again. I think wage growth is at its fastest rate for 10 years. So the UK economy, from a wages perspective and an unemployment perspective at the moment, looks positive. But of course, we did have that news, if you're in the UK, that Honda are going to shut down their big plant in Swindon. I think there's a couple of years left in that, but there's going to be 3,500 job losses to come there. Plus, of course, all the businesses around that surround that. But anyway, positive news this morning for UK employment. Let's take a look at what we've got for pound US dollar, because we'd had this great run from January. The lows in January, 124, up as high as 132 by the end of January. So we had an 800-point range in January. And since then, in February, the market has just slid. But maybe, I think I was saying yesterday, maybe we are seeing this market start to turn around. If we looked at the MACD and the RSI down here. So the RSI, first of all, I'm not a big fan of oscillators. I think the problem is they can take you away from what actually is going on in the market. But the RSI down here went oversold. That was last week, Thursday, Friday last week. So again, suggesting that maybe the sell-off had gone too far. The last time it was oversold, not quite oversold there, oversold back there. It's not done a bad job of calling the bottoms in pound US dollar over the last 5 or 6 months when it's gone oversold on the daily chart. The MACD down here, not quite giving a buy signal. Hopefully you can see that there. But again, if we had a bit of stability in the pound, maybe a little bit higher than here, we would get that buy signal from the MACD. So at the moment, the indicators are suggesting that maybe we're seeing the market starting to turn around. Let's take a look, pick it up on the charts. Let's have a look at the shorter term price action. So here we go. There's I think that was, I must have drawn that yesterday, I presume. So that was the trend we were looking at yesterday, looking something like that. So that has been the trends, sort of roughly drawn, for all of February. So we've seen the market just go try to rally, run out of steam, try to rally, run out of steam. End of last week, rallies, and it's actually broken above. So it's the first time we've seen this trend line break. So again, it does suggest that maybe in the short to medium term, the worst is over for pound US dollar, and we have to start looking for more aggressive targets. But I think, as I was saying yesterday, we've still got lots of problems running from sort of this 130 high, February the 7th, down to 129.60 from last week. Because the US was closed yesterday, it did end up being something of a quiet quiet day. And I think these are the levels to watch. I suppose if you wanted to be aggressive and you thought, right, this market is going to take off from here following the trend line break, the closest I would want my stop loss, if I was a buyer now at 129.22, is underneath the lows from yesterday. So yesterday's lows, to 128.90. So in the short term, just keep an eye on that level. It's only 30 points below, 35 points below where we are now. But I think it's interesting that it has broken out of this month's downtrend. Maybe the more interesting trade, if we see it come under a bit of pressure over the next couple of days, maybe down to the low 128s, then some strength comes in. I'd be happier being a buyer down here with a stop loss under that low from last week. But let's see what happens. I think it's interesting that it has broken out of its downtrend. But two markets that are moving, but again only gradually, because the US was shut yesterday, we're not seeing that drastic a move, but they are moving higher. Are the two commodities we look at: the price of crude oil and gold. So here's our big picture view for oil. So I do think, oil has come a long way in less than 2 months. It's up 30% from $42 Christmas Eve time, but our recovery is still going. Maybe it's overdue a bit of sideways sort of consolidation oil, but at the moment, yesterday, and I think this morning it did actually. Yesterday it did manage briefly to push just a little bit higher. You can see just how low the volatility has been this week so far because the US has been shut. Tiny candlesticks yesterday, but it did manage to push a bit higher. So again, I think, for now that recovery is still strong. I think that the next obvious target is maybe the $58 to $60 area. It's currently trading at $56.50 a barrel. But again, maybe the better trade is if we see it just unwind a little bit the gains of the last couple of weeks or so. So I've switched this over to an hourly chart back to those December lows. So maybe the more interesting trade is if we see it drop a couple of dollars back towards 54, but it's still strong. At the moment, it's still strong. It pushed out briefly to fresh highs yesterday. It's still holding today. So it's a market that's still strong. So in the short term, at least, we've got lots of support coming in from 50 all the way through to 52. So for me, it's only if it slips below $50 a barrel does it start to look as if this recovery is running out of steam. But for now, as we've seen through all the way through last month, being a buyer on dips has been the sensible way to be positioned on oil. So a little bit quiet, but still moving higher. And gold, I think gold has, yes, it has very briefly again pushed out. You can just see, this is an hourly chart. We'll flip it over to the daily in a minute. But you can see just, when is that? Just this morning, from about 7 this morning, it has pushed out through those January highs. So we're on fresh highs for the year. And of course, if we flip this over to a daily chart, it means that recovery from the August lows is still going. And I think, as I was saying yesterday, I think the obvious target, you can see where we are. We're at the best levels since April last year. So we're on a 10-month high for the price of gold. I think the obvious target, and it was a big hurdle, is 1360. So it was the highs from September. It had so many goes last year to try and rally properly through 1360, kept running out of steam. But for now, at least, that recovery still going strong in gold. So again, we've not seen dramatic moves over the last 24 hours, but both gold and oil pushing out to fresh recovery highs. So let's just flip it back to a short-term chart and look at some of the levels to look at on gold. Well, for me, I'd pick up on the old highs. Was it 1326 here? 1326, 1325. Let's just zoom in a bit on that. So I think, if we did see it cool off a bit from here, I think we've got support from 1320 from the 17th of Feb. when was that? Sunday night. So 13.20 through to sort of 13.26. If we did see it under pressure from here, but it's the same old theme for gold. You know, any weakness for now at least in the gold price, because we are 6 months into this recovery, still looks to be a buying opportunity for me, and that's been confirmed by the market pushing higher just this morning. You know, it does show, I think, the importance. We don't talk too much about strategy on these sessions because we sort of whiz through the markets. It shows the importance of trading with the trend. You know, when we had the trend from April till August last year for gold clearly down, spent a few months going sideways, but since I think sort of October, November, we've clearly been in an uptrend for gold, and that has continued this morning. So for now, any weakness in the price, I think, looks to be a buying opportunity. Let's see what happens. But those old highs from last year, I think, are the target for the price of gold. So let's take a look at stock markets. Let's have a look at the Dow. So we are back to normal today. We have seen, I think, these markets come under pressure a little bit overnight. So the stock markets were shut yesterday. There's a 24-hour market in the Dow, the S&P, the Nasdaq, etc. So they're still moving around. But normal trading starts again at 2:30 today, so just under a couple of hours' time. But just to flip it over, you'll see it has come under pressure. When did that sell-off start? Probably this morning, about 9 o'clock this morning. We've seen the Dow go from about 25.9 down to 25.800. So we've seen a 100-point drop ahead of the open. But I think it's interesting here. I think this could be an interesting week for stock markets, because going back to the daily chart, look how far we've come since those Christmas lows at 21,700, around about there. The market's rallied 4,000 points. It has been almost this V-shaped recovery that we've seen, but we are back now to an area where if it's going to run out of steam, then here we are. Okay, so it's the highs from early November up about 26,300. The highs from early December around about 26,100, and the market last week got as high as 25,940. Okay, so I think it's going to be interesting. Now, of course, looking at the indicators down here, the RSI first went overbought about a month ago because this recovery was so strong. The market's continued higher. The RSI has stayed pretty much overbought. MACD did give a little blip of a sell signal just about there and then changed its mind. So, but again, the MACD is pretty much at its most extreme reading for where we've got to go back to for a year. Okay, so which is not surprising. You know, the market has moved 4,000 points higher with barely a couple of days of selling off. So I think it's interesting here. But for now, that short-term trend is up. So let's look at some levels going into this afternoon. So I flipped this into an hourly chart. So there's the size of the recovery. That's the Christmas Eve lows. The market gaps higher on whenever it was, Boxing Day. And we've just, you can see the trend. We've continued higher. So, you know, some obvious levels to look at. Well, I think that sticks out as an obvious low, 25,200. That was from just the end of last week, and the market continued to move higher since then. And looking at the hourlies, that's probably the first obvious level, the big level, 25.2 from last Thursday, and pretty much the same. Sorry, 25,300, and then 25,270. So that's an important area to watch, but it's still 500 points lower than where we are now. So let's take a look if there are any other shorter term levels to pick up on. But for now, at least, you know, we'd still, like we've seen in oil and gold, the trend is clearly up. So technically, we still want to be a buyer on dips. What was the end of last week? So was it the 15th last week? So what were the lows from Friday's session? So the lows from Friday around about 25,650. So that's maybe one area to watch. But you know, let's see what happens. But going back to the day, I would still be looking to buy weakness. But going back to the dailies, let's just be aware that for the Dow and for the S&P, you know, we're back near levels that were real problems last year, and we have come a long way. So let's take a look. Someone's asking for the DAX. We'll take a look at the DAX now because we normally do the DAX anyway, and also the Footsie, because the Footsie's been interesting. So so the DAX has been an odd one. It has been really doing its own thing, because while other markets were going up last year, the DAX from June of last year was in a downtrend, and it's still in it. Despite the fact it's been dragged higher by this US market recovery since Christmas. The DAX has moved, what the lows, 10,300. The DAX has moved about 1,000 points higher as well. But the downtrend is still there. So again, it's sort of make or break time for the DAX. 11,600, I think, is the big level for the DAX. It's 300 points higher than where we are now. But again, if you really wanted to short the DAX, based on the trend, based on the technicals, it's looking like a good area up here. It's interesting, isn't it? And it's all about what happens in the US. If US markets burst higher again, I would assume the DAX is going to get dragged higher too. Yeah, but 11.6 is the big picture level for the DAX. I think if we flip it over to a shorter term chart, we've had not much in the way of volatility the last couple of days because the US has been shut. Here we go. This relatively tight range, 11,255 to 11,380, so 120 point range the last couple of days for the DAX. At the moment, what were the lows from yesterday? Let's have a quick look. So the lows from yesterday were, I suppose, again, the aggressive trade for the DAX. Yesterday's lows in the morning were about 11,256. The market did spike at about 11:30, about 15 points below that level. I suppose, again, the aggressive trade is, if you think it's overshooting yesterday's lows, to be a buyer with a stop under the lows for today so far. But personally, I'd rather wait to see. Let's see how US markets open this afternoon. And then finally, and then I'll get into the questions. If you've got any questions, fire them in. Finally, the Footsie, because the Footsie's been interesting with that 7,200 level. So let's just remind ourselves what we were looking at on the Footsie. So here's the big picture view for the Footsie. So we'd had this trend from up here, looking something like that. The market, the index, broke out during February. And I said, well, maybe 7,200, we need to see a breakthrough there. We have seen it break through. The market's been as high as, 72.66, something like that. And I think what's interesting now, I think it's always interesting when markets move against the trend. And the trend for the Footsie, as with US stock markets, has been up since just after Christmas. So if we were picking up on maybe something like that, you could, the recovery trend looks like that. And if we flip it over to an hourly chart, here we go. So that was the move up above 7,200. So it's all about now, well, where does it stop? We've pushed higher, and we've sold off a bit. We've got lots of support running from 71.50, 71.25, and the big support back at 7,070, that sort of area. But again, it's all going to be about how the US markets perform this afternoon. So it'd be good, I think, to get this afternoon out of the way so we can look at it tomorrow and see how markets have done after the holiday. But for now, even though US markets are weaker overnight, that trend from December is still definitely up. So I'd still be expecting something of a snapback. Right, let's get into the questions. So there's a couple of questions coming up. So Apple's been moving sideways for a few days now. My moving average still show a possible bull run. Can you take a look at Apple? Yeah, Apple. I think we looked at Apple in January, didn't we? Because we had their earnings that came out, didn't we? So let's take a look at the dailies on Apple. And I think I wrote from memory, I think 140 is the bit. So $140 a share was the big level for Apple. So we've seen this rough downtrend that had been in place for the last couple of months of last year. 140 has been an important low in the past, going back to 2017. So it's almost a 2-year low for Apple, 140. So for me, if I was a buyer for the long term, I would ideally want my stop below 140. So we did have the market gap higher on the results. I think I remember talking about it the day after the results, whenever that was, end of Jan. So we had the market, the shares gap higher through 160. And they've pushed as high as 175, and you're right. That is pretty sideways over the last few days. For me, the bit I'd be interested in is what it's done this year. So let's say we were going to try and structure some sort of trading idea. For me, it's all about this recovery from the early January lows. So for me, uh, let's just pick up on like the trend first of all. Maybe looks something like that. So for me, that recovery is still going. So if I had to do something because I want to go with the trend, I'd rather be a buyer than a seller. So if we're going to be a buyer at 170, what's the closest you'd want your stop? Well, I suppose you could say that below the lows here from the 8th of Feb, so somewhere the other side of 168. But ideally, I'd probably want mine the other side of 160. So I think in the short term, the 160 level is an important one because it had been such a problem in December. Then it gapped through on the results. If it goes back below 160, we're back to where we were before their latest earnings update. So I think it is positive in the short to medium term. And on this hourly chart, 160 is the big level, but the really big level is 140. So let's see. Let's keep coming back to it every now and again. See what it's doing. Excuse me. Silver. Someone's asked about silver. I did have a brief look at that. I think it was last night I was having a look at that because it's moving. I think different to gold at the moment. I think, but let's have a look at silver. So let's bring this up on the dailies. Oh, actually, no. It is. It just took a bit longer, I think, to turn around compared. It's been maybe a weird few years again. So this has been the last. When were these highs? July 2016, up at just above $21. The market traded as low as 14 last year. So I suppose if you wanted to be a bit pedantic about it, you could argue that if we picked up on maybe this sort of gradual trend thing, I suppose you could argue that the trend for the last, what's that, a couple of years nearly, is still just about down. So I suppose if you wanted to be, if you thought, right, I want to buy silver, but I'm going to be ultra cautious, you'd want to wait to see if that trend ended. But for maybe the more short-term focused, what we'd be looking at is the move since November last year. So something like that. So we do have, I think, almost these two conflicting trends. I would argue that gold is the stronger. Let's say you had to buy a precious metal. Gold looks a stronger market because gold today has broken out to a 10-month high. We're not there on silver. But that recovery on silver from these lows is still going. This is still the daily chart we're on, isn't it? That we're not getting too much. The RSI is pretty much in the middle. MACD is about to give a buy signal. I suppose an aggressive trade, you want to be a buyer at 1585, where it is now, and you put your stop loss. For me, the closest I want my stop loss would be these lows from January, 15, 16, that sort of area. So maybe the other side of 15. Personally, is the closest I'd want it, but I would just be maybe a bit concerned by that trend that is still arguably just about intact from the last couple of years on silver. So let's see. But it's an interesting one. So the question was, how do you see it for the long term? I think it can squeeze higher, but I think gold looks more positive. That's what I would say, because we've still got this downtrend. So maybe we'll just have a bit of banging around for the silver price until it decides. Someone's asking about New Zealand dollar, Canadian dollar. Let's take a look at that. Let's take a quick look at that. Sorry, hang on. Let's bring that up. What am I looking at? Trades. New Zealand dollar, Canadian dollar. Okay. I suppose it is a short. I suppose if you wanted to do anything, you'd be short, wouldn't you? It's interesting this actually, because clearly we had the trend up, the run up in the New Zealand dollar versus the Canadian dollar from October through to December. Goes a bit sideways, and then it started breaking down. 89 has been the floor, hasn't it? 89 has been the floor so far this year. But on the upside, if we flip this over to an hourly chart, I think we'll see it a bit clearer. It's had a real problem with sort of 91 to 91.20 and it's happened again, isn't it? So it looks, it rallies up, sells off, rallies, sells off, rallies, and here we go again, sells off. So the only question would be, I mean, where would you go short? The quick answer was yesterday was the better place to go short because you could have a tight stop loss, but it does look a bit weak, doesn't it, in the short term? So yeah. So for me, I think it's easier, in terms of risk reward. I think it's always better, isn't it, to be going short on run ups to 91, because it can still rally a bit and then drop down, but it does look, I think, negative in the short to medium term, doesn't it? And then someone's asking about Coca-Cola. So US share Coca-Cola. So I think it's also listed in the UK, isn't it? There it is, Coca-Cola. Let's bring that one up. I'm guessing, yeah, that's the US listing. So look, it gapped. It did have. I didn't read the story, but I remember seeing something about its results. Was it last week? Let's take a look at the dailies. That's had a move, isn't it? That's gone from what, $50? Well, I suppose a 10% move end of last week, a 10% fall end of last week, presumably on earnings. So let's just try and take a look at the bigger picture. I mean, for me, I would say that probably for me, the trade I would be tempted to do there is to be a buyer, based on the fact that, so this is the, and clearly none of this is financial advice, but clearly we've had this reaction to earnings, and it finished last week at about just above $45. So for me, I'd be watching to see where the buyers come back in. So we've got lots of support. It'd be interesting to come back to this later this week. We've got lots of support running from what, 43 through to 44, near enough. So for me, this is an interesting one, I think, to see if we get a day where it stabilizes. So maybe we've seen this reaction, maybe it's been overdone, we don't know yet. We see a day where it stabilizes, and then maybe we want to be a buyer with a stop loss under 43. Clearly, if it keeps on going down, I wouldn't do anything. But I think that's an interesting one, that where we've seen it sell off so sharply. It did sell off for a couple of days. Let's see what it does this week. So if I remember, or if you're around later this week, ask the question again, and we'll come back to it later this week. So that's it then, isn't it, today? So back to normal this afternoon, because US markets are open this afternoon. So like I say, we are doing this this event at Heathrow at the end of March. So if you want to make sure, we are going to send an email out to our clients, but it's open to clients and non-clients. So we'll talk about trading strategies, risk management, that sort of stuff. So if you want to make sure you're on the list, it's March the 30th at Heathrow on a Saturday. If you drop me an email, david.jones@capital.com, and I'll make sure you're on the list. We'll do this all again tomorrow, 12:30 tomorrow, see where everything is, see what the euro is doing, see if gold and oil have moved higher, and see exactly what US stock markets have done. So back to normal again. To never miss out, just make sure you're subscribed by click the subscribe thing down there. And if you click the alarm bell next to it, you get a push notification off YouTube when we go live. But we'll wrap it up there. Thanks for coming along, and hopefully see you tomorrow.